Corporate Finance Excel Practice Problem. In this presentation, we're going to work a practice problem. This will be the second practice problem of its kind, the first part of the second practice problem of its kind, related to the degree of operating leverage, degree of financial leverage, and combined leverage, part 1. Get ready. It's time to take your chance with corporate finance. Here we are in Excel. We have our information on the left-hand side. We're going to put that information into the blue area on the right-hand side. We're going to be calculating the degree of operating leverage, degree of financial leverage, the degree of combined leverage, and the break-even point in units. We're going to do a couple different scenarios, focusing in this time on the degree of operating leverage, and we're going to do another scenario down here to see the effect of some changes in the degree of operating leverage. Then in part 2 of the practice problem, we will continue on with the degree of financial leverage, the combined leverage, and the break-even analysis. So this is going to be our formula up top, degree of operating leverage. There's a couple different ways that you can calculate this. I would memorize it as the contribution margin over the contribution minus the fixed costs. But in order to do that, and you can also think about it even more shortly as the contribution margin over operating income. But you just got to remember, what's your definition of operating income. If you do that, it'll be a little bit faster to do that. But if you memorize it as one of these first two, then you just got to know what the definition, of course, of these two items are. The top definition being the contribution margin, which could be said to be the total contribution margin, sales minus the variable costs, which means we've got to format our income statement in the format of a contribution margin income statement as opposed to like a normal formulation of an income statement. You can calculate that as the total sales minus the total variable costs, or you can calculate it as the price per unit minus the variable price per unit, cost per unit, variable cost per unit times the units that are going to be sold, divided by that same amount, the contribution margin minus the fixed cost. So contribution margin minus the fixed cost. Now, you can also do it, and we'll see this in a future problem, where you have the percent change of operating income and the percent change of sales. This would be another way that you might go about figuring this out. You might use this method in the case where you don't have as much financial data. For example, if you're not the company that's creating the information, you may not have a contribution margin income statement, and it may be easier for you then to use some alternative method if you're looking at financial statements for another company from an outsider that are public financial statements that will not be in the format of a contribution margin income statement, but in the format of a standard income statement. Okay, so information on the left is going to be the income statement in basically a contribution margin format. We got the sales, unit sales times the price. That gives us the sales side, and then the units times the cost, the variable costs, will give us the variable cost, and then if you subtract those out, that would be the total contribution margin, but we're just going to subtract out the fixed costs. That will give us the earning before taxes and interest. Then we'll subtract out the interest to give us the earnings before taxes, then subtract out the taxes to give us the earnings after taxes. Okay, so we're going to do this first calculation. We're going to be looking at basically this formula, which I would memorize in this format of the ratio contribution margin over the contribution margin minus the fixed costs, or otherwise known as the operating income. I'm going to do that in like a tax return type of format. So basically the column to the outer column will be the final numerator and denominator that we will then divide, and we'll show kind of a tax type of format if you're going to make a tax return layout of this formula. You can use an algebraic formula to plug the numbers into this format as well, but I find it useful to kind of break this thing out into a more expanded kind of worksheet format. So first we're going to calculate the numerator. That's going to be the contribution margin. So once again, we could do that two ways. I could just subtract these two numbers out because we already have them here, which would be the sales minus the variable costs on the totals. But we're going to do it the way that it's given in the formula here. So we should get to that 600,000, which will be this format, subtracting the price per share minus the variable cost per share times the units. So let's first then calculate, let's think about the units that are going to be sold. So I'm going to say, let's just say units sold is going to be equal to the 12,000. That's how many units we're going to sell. Then we're going to calculate now, that's going to be this X right here. That's what that stands for. Now we're going to calculate the contribution margin. So the contribution margin And that is going to be, and actually this is the contribution margin per unit, I should say. Contribution margin per unit as opposed to the contribution margin total, which is what we're going for overall. So I'm going to put another colon here too to represent that we're going to have another kind of sub-calculation. We're going to take the unit price. The unit price is going to be the $90, and we're going to be subtracting out the variable cost per unit. So the unit variable cost, or variable cost per unit, $40. That's going to give us our contribution margin per unit, and that's, I'm going to bring that to the outside. This is going to be equal to the 90 minus the 40, or the $50 per unit. I'm going to put an underline here. I'm going to put an underline there. We're then going to say this is going to be the contribution margin, and I'll bring this out to the outside. This is going to be now our numerator. So we're multiplying, what would be in the brackets, the contribution margin per unit, times X, the units sold. So that's going to be then the 12,000 times the 50, and that's going to be, once again, that $600. Let's go ahead and format this. I'm going to select these three cells, go to the Home tab, Alignment, increase the indenting, then the Contribution margin, Home tab, Alignment, increase the indenting. Now we're going to calculate the bottom half here. So the bottom half, which we can label out as the contribution margin minus the fixed costs, or otherwise call it the operating income. So let's go ahead and do that. I'm going to take the contribution margin, which we calculated up top, and that we already have. So that's going to be the 600,000. And then I'm going to subtract out the fixed costs. Fixed costs is going to be then equal to the 350,000. The 350,000, and that's going to give us to our contribution margin minus fixed costs. I'm going to get rid of the colon here. So there we have it, and we'll subtract this out. This is going to be equal to the 600 minus the 350. That's going to give us the 250. That, of course, lines up to the 250 here because, once again, that's basically operating income. Another, formulation you might see for operating income is earning before interest and taxes. In other words, you can basically rename this line oftentimes as operating income. So then I'm going to put an underline here. Let's put an underline there. Now we've got the numerator, the contribution margin, denominator, operating income or contribution margin minus the fixed cost. We can go ahead and divide them out. Those are the two items in the outer column. I'm going to put an underline here, and this will be calculating the degree of operating leverage. And this is going to be equal to then the 600,000 divided by the 250,002. Let's add some decimals. Go into the Home tab, Numbers, and add a few decimals there. We've got the 2.40. 2.40. It may have more decimals. Let's just check it out. No, it's nice and even. That's nice. So what does that mean? That means we're trying to figure out basically the leverage, kind of the risk related to having between having fixed costs and variable costs. So the higher the fixed costs in relation to the variable costs, the more leverage you will have with regards to this leverage, in a similar way as the more debt you would have in the company. You could think of that being as a more leveraged position on the debt, leverage, or the degree of financial leverage type of perspective. So with that means that if more leverage means that you could multiply gains in good times, and you could multiply problems in basically bad times. So that comes with risk and reward. The reward could go up in good times, but the risk is higher. If things go down, then the risk could be high in cases of down times. So let's see. There's a nice little way we can calculate this too, to think about, well, what if there's an increase in sales? What then would be the increase in earnings before interest and taxes, or operating income? So if there's a 10% increase in the top line in sales, if we use this number, the degree of operating leverage, we can then say that the 2.4 times the 10%, and I make this a decimal by going to the Home tab, Numbers group, and percentifying it, means there's going to be a 24% in the increase in earnings before interest and taxes. So to prove that, we can actually, copy out our income statement down here. and I'll just increase. So I've got the same income statement. Everything's the same, except that I'm going to increase the units that we sell by 10%, which is going to increase the sales by the 10. And then the variable costs will follow because they vary with relation to sales. So I'm going to increase the 12,000 units we're selling by 10%. Let's do that by saying this equals the 12,000 and then times, I'm going to say 1 plus 110%, which is this 10% there. So that's going to be the 12,000 times 110% would then give us the 13,200. Now the variable costs would then increase in terms of units in proportion. So the variable costs will then increase in proportion, but the fixed costs will not change. And that's kind of like the point here. So then if we get to the bottom line, let's think about what the increase would be then. If I was to use my calculation up top, the 24% increase here, let's take that increase and say, okay, here's the earnings before interest and taxes. Let's increase that by 24%, which would take that 250,000 times 124, 1.24, right? So we're going to say this is going to be equal then to the earnings before interest and taxes times brackets. I'm going to say 1 plus this 24%, closing up the brackets, and there's going to be our 310. So we would expect then a 10% increase in sales to create the estimated earnings before interest and taxes, 310. Now we've increased the sales by the 10%. Let's see what actually happens here. We've got that 310% increase. Now you can double check that there's a 24% increase. Now going the other way, I could say, well, here's the new number that we've adjusted to, and this is going to be the 310. This is the prior number. This is prior number, which was, I know this wasn't labeled, not the best labelings there, but earnings before interest and taxes. We have the change then. The change is going to be, this will equal the 310 minus the 250. Let's put an underline here, home tab, font group, underline. And then we can say that the increase in the earnings before interest and taxes, or the percent increase, let's say the percent increase is going to be equal to the change divided by the beginning number, which is the 250. So let's make that a percent. Home tab, numbers group, making that a percent. There's the 24%. Now you can also do that this way. You can say the percent increase calculation. Let's just do it with a formula so I can do it all in one place. We're going to say this will be equal to, we're going to say the new number, which is this 310, minus the prior period number, which is the 250, close up the brackets. So that's what we got so far. And then I'm going to divide it by the prior period number, the 250, and make this a percent. Home tab number, making that a percent, and there's the 24% once again. Okay, so that's a nice little feature. Now let's think about what would happen if there was a change in the breakout between the variable costs and the fixed costs. So now we're going to take the next scenario where we are getting to the same earnings before interest and taxes, the 250,000, but we have a difference between the breakout of the variable costs and fixed costs. So we're comparing this to the first item up top. If I go all the way up to the first item, we have the 250 earnings before interest and taxes, but variable costs were $40 per unit. Fixed costs were only $350. Now we have the 250,000 earnings before interest and taxes, but the variable costs are now 10, and the fixed costs are much higher at the 710. So let's calculate our calculation here. Once again, I'm going to use some formulas to do this. What I want to do is bring down the same amounts up top. I'm going to do that by using a formula, saying equals, and pulling over these numbers as if they're a formula. You can copy and paste them, but I like to tie it out, everything out, even the amounts, or not the amounts, the text, if possible. So I'm going to do the text with a formula. I'm going to say this will be equal to, we're going to be picking up this number here, or this cell, and enter, and then we're going to autofill it down. I'll put my cursor on that item and then use the autofill to populate it. Then I would like to use the formatting to format this entire square in the exact same format as up here. So what I'm going to do is I'm going to select this entire thing. I'm going to go to the Home tab, Clipboard, and Format Painter, and then scroll on back down, and we're just going to format paint that entire thing. So there we have it. Now we'll just do our same calculation here. So we've got the units sold. I'm going to put that in the middle column. Units sold are going to be 12,000. That's going to be X in our formula, you'll recall. And then we're going to say that we have the unit price. Unit price is going to be the 90. That's going to be the P in our formula, and the variable cost is going to be the 10 per unit. That's the variable cost in the formula. That's going to give us our contribution margin, which is P minus the variable cost, P minus VC. That's what that is, the contribution margin per unit, I should say. And so now we've got X and the contribution margin per unit, and we can then calculate the contribution margin. The contribution margin per unit, and we can calculate the total contribution margin, which is the numerator, which is going to be equal to the 12,000 times the 80. So there we have it, numerator calculated. And then we go to the denominator. That's going to be the contribution margin. Contribution margin, same calculation here for the contribution margin minus the fixed costs. So the fixed costs are going to be this 710, which is going to equal the contribution margin minus the fixed costs, or the contribution minus fixed costs, which could be the earnings before interest and taxes, or operating income, or other ways that you can say that. Pick up that number. It kind of depends on the format of the income statement as to how you're going to get to that number. So then we can then divide this out. We're going to say that this is going to be the 960,000 divided by the 250. That's going to give us now 3.84. So you can see now that this, of course, is a higher number. So the higher the operating leverage, the more leveraged they are. So that means risk is higher. So you can think of it, well, is that good or bad? Well, risk is higher, but if the things turn out well, then you could have a multiplier effect on the returns. If things do not turn out well, you could have a multiplier effect on the negative outcome. So risk of reward often is benefited by the leverage, but so is the risk of multiplying a decline if there's a declining component or declining time. So we're going to then say that the increase in earnings then, if I said, well, what if there's a 10% increase in earnings now? We could say, all right, a 10% increase in sales would mean we're going to take that 3.84 times that 10%, make this a percent, go into the Home tab, numbers, percentifying it, and that would be a 38 about. Notice we could add decimals here. I'm going to keep it at the 38, about 38 increase in the earnings before interest and taxes. We can then prove that by saying, or we can estimate what the earnings will be then based on that information. So let's say, okay, let's go ahead and estimate this. This is the earnings before interest and taxes. We're going to increase that by 38%, meaning we're going to multiply it times 1.38. So I'm going to say this is going to be the 250,000 times, and we're going to say this is 1 plus the 38%, or 1.38, and that'll give us the 346. So we're estimating that if there was a 10% increase in the sales, we would have the operating income, or earnings before interest and taxes, two names for basically the same thing, of 346,000. Let's go ahead and prove that with our income statement. Just recalculate the income statement here. I'm going to then increase this 12,000 once again by that 10%. So that calculation is going to be equal to the 12,000 times, and I'm going to say brackets 1 plus that 10%, which would give us 110%. And so that's going to give us that 13,200, which will give us a 10% increase in sales. We will have a corresponding increase in the variable costs because they vary with sales, but the fixed costs will not. And that's going to be our difference. So now let's calculate, if we look at then the earnings before interest and taxes, we have the 346,000 that we estimated here. So now we've calculated it with the full income statement. Let's recalculate the increase now, that 38% increase, which we can calculate as saying, well, here's the new number. This is the new number. If we were to have that increase, we come out to the 346,000, and this is the prior number. We were at the earnings of 250,000. That change then, the change is equal to the 346 minus the 250 or the 96,000. Let's put an underline here, home tab font and underline, and then we're going to get the, let's just call it percent, the percent change. So percent change is going to be equal to the change divided by the prior period. That's how you get the percent increase or decrease. Let's make it a percent by going to the home tab numbers group and making it a percent. So we could do that, and that's that 38%. So now we're just kind of recalculating it the other way just to prove this item. Let's do it just with a formula now. So if you wanted to do that with just a formula, we could say this would be equal to brackets the new number minus the prior number, close up the brackets because we have to have order of operations, and then divided by the prior number. So we have to be able to subtract before we divide, so we need the brackets here. That's going to give us then a 0 until we change the cell, home tab, numbers, percentage. There's our 38% again, about. So you can see here that if we see what's the effect of the operating leverage, well, when we had less fixed costs, we had the same earnings before taxes, but we had less proportion being fixed costs and more for the variable costs, we were less leveraged, and therefore if we had a 10% increase, it resulted in sales. It would result in a 24% increase in basically kind of like the net income or operating income, and that would be 310,000 in this example. Whereas if we're more leveraged down here, same operating income or earning before interest and taxes, but now break out more on the fixed cost side of things than the variable costs, therefore being more leveraged in terms of the operating leverage. Now we have a higher degree of operating leverage, and then we can imagine that if there was an increase in sales by the 10%, then the increase in the net income or earnings before interest and taxes, operating income, would be an increase of 38%, which would now be estimated earnings of the 346 versus the 310 we saw in the past. So the more leverage, is going to have a multiplier kind of effect on the increase in the sales, and that's going to be the 346 here. Now you can also see if there was a problem then, if sales decreased, in other words, by 10%, you would have a 38% decrease, which would be an estimate going down. So you can see if sales go up, then the multiplier effect would be good on the positive, and then if sales go down, you could have a multiplier on the negative, meaning the more leveraged company could have more potential in terms of growth periods and more risk in terms of down periods, just as normal leverage would be calculated. When you're thinking about, I think about normal leverage, I think debt, leverage related to debt. So leverage related to operating leverage, fixed and variable cost acts similarly. So next time we're going to be calculating the degree of leverage on the degree of financial leverage, and then we'll get into the degree of combined leverage, which will be a combined number between the two and the break-even point in units, and you can kind of think about how that fits into the concept of leverage.